Kathy Weaver with Weaver Financial. Let's do the numbers. First, though, a preface. This was written during last week, ending April 11th. Much in the markets and in the news seems to be doing 180-degree flip-flops these days. This narrative has not been rewritten for the weekend's news releases. In a nutshell, bonds have a small positive return. U.S. stocks are down and up significantly. Overseas stocks are down, but less so. Need I mention this tariff brouhaha? The first quarter was consumed by uncertainty, mostly from the political quarter, some from concern about U.S. companies' growth rates in 2025, some from concern about the very high valuations in our large-cap stock market. For what it's worth, at quarter end, U.S. large company stocks were down 5%. Small company stocks sank 9%. Overseas stocks returned a positive 7%. Yields on bonds dropped a bit in a flight to safety. The bond index was up 2.6%. These first 2 weeks in our second quarter have brought, if it's possible, even more uncertainty. Let's face it, all these trade negotiations will take time to sort out. Rumors abound. The press is reporting every piece of drama, perhaps jumping the gun in cases. Businesses will have to make CapEx, capital spending, and supply chain decisions now, based on both current and future political administrations. Many of the decisions they do make cannot be implemented overnight to save their profit margins. If you think the proclamations from the political side, plus the frantic negotiations, are a moving target, consider the effect on corporate earnings. Morningstar's The Morning Filter podcast recently reminded me that not all companies are significantly affected by tariffs. Pharmaceuticals are excluded so far. Products which fall under the USMCA trade agreement are excluded so far. Dollar Tree imports 40% of its goods, yet Dollar General imports only 4%. Wall Street analysts are hustling to analyze these direct impacts, but their projections aren't finalized yet, nor has Wall Street sifted through the ongoing tumult to analyze the indirect impacts. You're seeing some already. Slower expected U.S. growth has lowered the price of oil. Slower tourism into the U.S. is lowering airlines, travel, leisure, etc. But only in a general sense, not by using specific corporate earnings projections. Bottom line, wait and see. Last quarter's newsletter said most pros expect a year of ups and downs. Hold your seats. So ditto. We can reasonably expect to know more on most of the trade negotiations in a quarter or two. We can expect to be able to assess near-term impacts on corporate earnings in a few months. Is there a silver lining in any of this? Yes. Market valuations were breathtakingly high. Those have come down and are more moderate now. A very few pros have said the market may be closer to buying levels. Second, our overseas stocks are losing much less than our U.S. stocks. Third, all of our bonds are pushing against the trend, contributing positive returns. That's 35% of your money for most of you. So let's get back to basics. The Federal Reserve wants inflation to return to 2%. It's been inching back up instead. The Consumer Price Index was 2.4% the 12 months ending March, a move in the right direction, down. Unfortunately, though, inflation expectations that anticipated by consumers had risen to 5% in March before the tariffs were announced and are now 6.7%. The Federal Reserve paused interest rate cuts in 2025 after cutting 3 times in 2024. Because tariffs slow the economy and tend to increase prices, the Fed will need to work harder to curb inflation, usually done by raising rates. Most economists and market pros foresaw an economy slowing down a bit in 25. In the March job report, wage growth was 3.8%. Okay. Labor force participation was still steady at 62.5%. Unemployment crept up to 4.2% in March. Jobs created was very solid. But those statistics do not reflect the Doge layoffs or the business reactions to these tariffs. Stellantis, Chrysler's parent, just laid off workers in U.S. plants which use parts coming from Mexico and Canada. As a consequence, the Federal Reserve may be pressed to cut rates to ameliorate the damage to the workforce. Stagflation, higher inflation paired with slower growth, is a difficult nut to crack. Small companies get hit the worst in these environments. They have less flexibility, lower cash piles, fewer supply chain options, and more. Overseas companies are faring better than U.S. companies, since the U.S. is but one market for them, and the U.S. is tackling all countries on tariffs at once. The U.S. economy grew a revised 2.3% in the fourth quarter and a nice 2.8% for all of 2024. The Atlanta Fed's GPT Now tool is estimating negative 2.4% growth for the first quarter, a contraction in economic activity. A month ago, it was predicting growth of positive 2% or more for our first quarter. We don't have retail sales yet, but consumer sentiment continues to fall based on the University of Michigan survey. 70% of our economy is from consumer spending. Many pros have raised the odds closer to 50-50 on a recession. Regardless of this blinding blizzard from tariffs and immigration, it still drills down to interest rates and corporate earnings. Most pros expect the Fed to cut rates 1 to 3 times now this year, depending. Corporate earnings are estimated to grow 5 to 8% first quarter. Estimates going forward for the full year 2025 are revised repeatedly now. We should have a better gauge in a quarter or two once we have more solid data. Europe's economic growth continues to lag. They've recently been adding stimulus, particularly in Germany, but tariffs will represent a headwind for them. Europe is an export-driven economy. The U.S. is their largest trading partner. The two wars may be lost from the press headlines, but not on the expense toll they represent to Europe. Fortunately, their stock markets didn't rise excessively in prior years, and fortunately for us, their markets have withstood tariff shocks better than our U.S. stock markets. China's economic growth is still higher than ours, 4.5%, but only 15% of their exports go to the U.S. About 17% of U.S. exports are from China. Very few of our core funds in the portfolios hold investments in Chinese companies, but many U.S. companies operate in and export to China. China has 1.4 billion people. The U.S. has 0.4 billion. There's a whole lot we don't know at this point, but we do know that diversifying investments cuts our losses in down years. We do know that diversifying still lets us enjoy nice gains in up years. We know that the U.S. markets have substantially more positive returns than losses over the long term. We know that strategies such as dollar cost averaging and tax loss harvesting work well in the right situations. Our bonds have beaten the bond index in almost all years. Our stocks are well diversified to temper market losses successfully against the indexes. It's important to define what we know and work with that. Thank you for your interest. Please call or email if you want to dig in further. I'm glad to pass on my readings, podcasts, and the other sources.